So you've gone through the fundamentals of setting up the T-charts for margin. Let's dive into some examples. I'm Brian Marks, the president of Notman Marks Financial Training, and welcome to the Vault. In the prior video, if you were watching in order, which I hope you were, we talked about setting up the T-charts. Let's go through an example, and we're going to start with long margin accounting, and we're also going to start with talking about when things go well. The next video is going to talk about when things don't go quite as well, but we're going to start with the upside, and we're going to start with the optimistic case. Reminding you of some of the fundamentals. So when you open a new position, you got to put up 50%. That's your down payment. Just like for a mortgage, it's maybe 5%, 20, 25%. For equities, it is 50%. After that, if you fall below 50%, it's no big deal. You have a problem when your equity falls below 25% of the market value. And again, this particular video is going to talk about when things go well, so neither of these scenarios are really going to come into play. I mentioned in the prior video, the very first thing is to set up your T-chart. Very first thing, you get a margin question on the exam. It's just therapeutic. Draw that T-chart. There you go. It just makes you feel good. It feels like you have this visual framework. In our first example, an investor is going to purchase $80,000 worth of stock, and they're going to meet Reg T. So you start with what do you know? What do you know? The long market value is $80,000. How do you know that? Because I told you so. I told you we bought $80,000 worth of stock. Now, we need to meet Reg T. We need to meet Reg T. Reg T, remember, that's your down payment. Reg T is 50%. So you need to put up $40,000 of cash. That's your equity. That's your down payment. You put up $40,000 of equity. And the left side always has to equal the right side. So if the long market value is 80 and the equity is 40, the debit balance, the total on the right, has to be 80,000. So now we have 40 plus 40 equals our long market value. Excess equity and SMA, we're going to talk about a little bit later. And remember, you don't get a margin call until your equity falls below 25% of the market value. So 25% of that market value is 20,000. We just opened the position, so it'd be pretty rough to have a margin call off the bat. But we have 40,000 of equity. We need at least 20,000 to avoid a margin call. Couple things to keep in mind here. The long market value, that's the value of the stock. So any margin accounting question on the test, you have to consider, is the long market value changing? If the long market value is not changing, if the value of the stock is not changing, this long market value will stay the same. For example, if you deposit cash, that doesn't change the value of the stock. LMB will stay the same. Debit balance, I mentioned this on the prior video. That only changes by customer action. That's your anchor. Only changes by customer action. If you deposit cash, receive a dividend, sell stock. What about a change in market value? That will have no impact on the debit. That's really, really important. A change in market value. Change in market value is no impact on your debit balance. No impact on your debit balance. All right, so let's keep going. So here we see our setup. We bought $80,000 worth of stock. This is what we just established as our initial setup on the prior slide. Let's assume the value of the stock increases to $120,000. We start with what we know. What do we know? The long market value is $120,000. How do we know that? Because I told you so. Remember I said the debit balance only changes by customer action. It only changes by customer action. Do we have a customer action here? We do not. The change in market value has no impact on the debit. So the debit balance will remain $40,000. And the left side equals the right side. So if the long market value is $120 and the debit is $40, left side equals the right side. The equity value is $80K. Now remember, Reg T is 50% of the market value. The market value is $120. So Reg T is $60,000. We have equity that exceeds Reg T. So our equity is 80, our Reg T is 60. When our equity exceeds Reg T, that gives us what's called excess equity. So we have excess equity of $20,000. And when you have excess equity, that creates SMA. So we're going to have SMA of $20,000. I'm going to talk about how to use SMA on the very next slide. You might be thinking, well, Brian, aren't excess equity and SMA the same thing? Not really. The tricky thing about SMA, it's like a high watermark. SMA will go up as your market value goes up, but as your market value goes down, it won't actually go down. It'll stay right where it was. It's kind of like a high water mark. It only goes down when you use it. That's not a critical point for this example. I just want to flag it. And of course, the stock is going up here, so we don't have to worry about minimum maintenance right now, right? Minimum maintenance is 30K of equity, 25% of the market value. We have 80K, so we're really happy right now. So what happened here, just to recap, the market value went up. When the market value goes up, well, your long market value changes. That's what happened here. The debit balance, there was no customer action, so the equity is the difference between the two. And if your equity exceeds Reg T, it gives you excess equity, which creates SMA. And again, the key thing here, every question, you draw out your T-chart. By the way, if you're wondering, I really like to practice this more. In our training center, we have lots of margin worksheets that go through exactly this. They just give you tons and tons of examples. All right, so now, here we are, 120K long market value, 40 debit, 80 equity. That's what we just did. Long market value is, SMA is 20,000. That's a line of credit. It's not our money. When you use a line of credit, what are you doing? You're borrowing money. So when you use it, what do you think goes up? Your debit. When you use SMA, you're borrowing, and your debit is the loan. So let's say we do that. Let's say we go ahead and do that. We can use SMA to buy more stock. Because Reg T is 50%, SMA has 2-to-1 buying power. So if we have 20,000 of SMA, we can use that to buy 40,000 of securities. So let's assume we do that. Our long market value is 120. We can use SMA to buy 40,000 of stocks, so our long market value is going to go up to 160. Now we have a customer action, though. We just bought stock. And what money did we use to buy stock? We borrowed the whole thing using SMA. Did we bring any of our own money from home? Did we go to the bank and hit up the ATM or go to a teller and get a pile of cash? No, we just said, hey, let's use that line of credit. So our debit balance now is going to go up by the full amount of the purchase. Our debit balance was 40. We used SMA to buy 40K of stock, so our debit goes up by 40K. Equity, the left side has to equal the right side. So 160 and 80, so therefore the equity is 80,000. Reg T is 50% of the market value, so Reg T is 80K, which is exactly equal to our equity, so our excess equity is 0. We used our SMA, so our SMA is now 0. Minimum maintenance is 25% of the market value. That's to avoid a margin call. And again, that hasn't been relevant to any of these examples because a margin call only might come into play when the stock is going down. And here we're pretty happy our stock's been going up. But in any event, our minimum maintenance here is 25% of the market value. That would be $40,000. So again, we used SMA. It has purchasing power of 2-to-1. So 20K of SMA allowed us to buy 40,000 in securities. That's why our long market value went up by 40. And our debit balance also went up by 40 because we bought 40,000 in securities using money that we borrowed. Now, you might say, well, Brian, I have this line of credit. Do I have to use that line of credit to buy stock? Can't I just take it out and go throw a party or go to a nice dinner or go do something else with it, buy a car? Sure, you can. So the other way to use SMA, now I'm back to my original balance where the stock went up 120, 40, and 80. So let's forget we did that about buying stock a second ago. This 20K of SMA, we could take it out in cash and throw a party. That would be quite the party. But we could take it out in cash and just go have a party. So let's say we do that. If we do that, are we impacting the value of the stock in our account? We are not. We didn't buy stock. We just took $20,000 cash home. But you take it home, remember, it's not your money. It's not your money. So the debit balance just went up. We just borrowed $20,000. We just called up the broker and said, hey, broker, I have this line of credit. I just want to take it home with me. What's the broker going to say? That's wonderful news. Why is it wonderful? Maybe because they get an invite to your party. No, the reason it's wonderful is because now you're going to have to pay interest on that money. So remember, the left side equals the right. So debit went up to 60. Our equity is 60. Reg T is 50% of the market value. So Reg T is 60,000. We don't have any excess equity because equity equals Reg T. We just used our SMA, so our SMA is 0. And minimum maintenance is 25% of the market value. Again, stock's going up here, so minimum maintenance has not really been relevant. So this is kind of our first half of the margin accounting calculations. What are the key takeaways? Well, the long market value, that's the value of the stock. Debit balance only changes by customer action, which is basically if you buy or sell stock. A change in market value has no impact on the debit. But by the way, we had a customer action here. Took out cash. If you take out cash, that debit balance is going to change. You might say, Brian, what about the other half? We're getting there. We're getting there. But that initial investment, what did we talk about here? The initial investment, we got to meet Reg T. SMA, that line of credit is created when your equity is above Reg T. That's 50% of the market value. And when you use SMA, you're tapping a line of credit. You're going to the broker and saying, hey, broker, can I borrow some money? And the broker is going to do that and then increase your debit balance. Now take a deep breath, because in the next video, we're going to see what happens when the stock starts to go the other direction. But for now, go to the worksheets, practice those worksheets, those margin worksheets in the training center. And again, that very first thing, anytime you get a margin question, just draw that T-chart. Feels good. That nice therapeutic T-chart. Know that you're going to be able to visualize your answer and get to the right place. And when you're ready, move on to what happens when the stock starts to fall.